Good morning from my world headquarters in New York. I'm Manus Cranny. Welcome to Bloomberg Brief. Let's set your agenda. Powell signals the Fed has time to assess the data before deciding on rate cuts.
On inflation, it is too soon to say whether the recent readings represent more than just a bump. We do not expect that it will be appropriate to lower our policy rate until we have greater confidence that inflation is moving sustainably down toward 2%.
Apple explores personal robotics in the next big bet as that car project fizzles. And the Disney CEO Bob Iger won the proxy war, but now he has a battle of unresolved challenges, from the struggling movie business to finding his successor. A very good morning. The soothsayer that is Jay Powell reaffirming the cuts are coming, fear ye not. And that, to a certain extent, took the bond market ratcheting off the boil and gave some spirit back to the equity markets this morning. In terms of flow, Citi are saying there is persistent risk demand for equities and momentum. It may be shaken a little bit this week, but the fundamental flows into equities are there. $16 billion in net long. So we are just seeing a rising tide this morning. We're counting down to the jobs report tomorrow. It's interesting in terms of those stocks that are moving. Meta has a nice bid this morning. That is more on the back of an upgrade from Wells Fargo, seeing 20% upside in the stock. The stock is up 1.25% this morning. The robotics headline in Apple, everybody was sort of pretty much, yeah, they're not that bothered, or perhaps they lack belief. So the cuts are coming. That is the deja vu. John Arthur's encapsulated it beautifully. You have deja vu. They're coming. They're coming. They're coming. Just calm down and wait for them. But have a look at the bond market, because the bond market waits for nobody. It saw prices paid yesterday come in at a 4-year low, and that is what it took it off the zenith. Still, over the 4 trading days of the week, you're up 15 basis points. We were up 22 basis points at one juncture yesterday. It's all just a bit vague. I love what BMO, Ian Lingen, had to say. All the waiting and no seeing. So these are inflation bumps, according to Powell, and we must all be stoic and calm down. And with that in mind, Chair Powell signaled that the Fed is still on that rate path amid recent inflation figures.
These recent data do not, however, materially change the overall picture, which continues to be one of solid growth, a strong but rebalancing labor market, and inflation moving down toward 2% on a sometimes bumpy path.
Well, my next guest says this. I'm going to take you back to a pretty horrible period of time, 2007. The Fed had aggressively hiked in 2005 to 2006 and went for a long 15-month pause. Pretty much the same as what's happening now, with the first Fed cut continuously postponed and a long pause happening. What happened after in 2007? Well, some of us lived through it. It was a pretty torturous time. Alfonso Peccatiello is the CEO of Macro Compass. So I went back and I read the New York Times article when they cut rates in 2007. And they were cutting, to quote the New York Times, it was a bold acknowledgement that the mortgage market was in meltdown and plaguing Wall Street and Main Street. Alfonso, it is not 2007. Growth is firm. We do not have a crisis. Therefore, sir, I put it to you, this is not a 2007. We should not be correlating to them.
So I would say, Manus, that my, let's say, way of checking today's scenario against 2007 is more driven to the fact that the Federal Reserve back then ended up cutting interest rates by 50 basis points, despite core inflation, core PCE was annualizing over 2.5%, and the job market in the United States was still printing about 120,000 jobs a month on average. And in that scenario, the Federal Reserve, after a long pause, decided it was scared enough by some initial issues in the housing market and the mortgage market to come up and cut by 50 basis points. So what did the market do back then? Well, you had a big curve steepening. You had a big rally in gold, in oil, in commodities. You had the energy complex doing particularly well. And you had the stock market, specifically large cap, like tech stocks, for example. They did pretty well, thanks to the proactive easing from the Federal Reserve. Now, this time, the Federal Reserve is talking about cutting interest rates about 3 times this year, and maybe 3 to 4 times as well next year. So it's a proactive cutting cycle that is happening, again, on the backdrop of what? Well, core PCE is annualizing 2.5%. the job market in the United States is not weak enough to generally come with a cutting cycle. So the private sector is adding over 200,000 jobs on a 3-month rolling basis as we speak. And nevertheless, the Federal Reserve is talking about interest rate cuts. This time not because the mortgage market is under pressure, but most likely because of politics, if you ask me. They want to get started before the election cycle gets very heated. And the market is behaving exactly the same way it was behaving in late 2007 from a commodity perspective. And also, I think the bond market is waking up to a steepening, which should happen if this is what we're going for.
So it's politics, not crisis, not an event-driven risk that will invoke this cycle. Okay, I mean, that is a moderately contrarian view. Powell himself talks about a restrictive. He's used the word restrictive. How restrictive are rates, given that FCON is pretty loose?
Well, that's a bit of the situation, right? If you ask the Federal Reserve, they would say conditions are restrictive because they look at a set of data, like, for example, lending to small firms, which has been coming down. But if you look at other metrics of financial conditions in market, it's hard to say that things are loose when meme coins called dog with hat is going up 3,000% over a weekend, Manus. I would hardly call this restrictive. Now, the situation is the following, that rates are restrictive, but specifically they are restrictive for countries outside the United States that have equilibrium interest rates and a structure of the private sector which is not as well as equipped to handle higher interest rates like it is in the US. So, for example, can we say that interest rates are restrictive in the UK or in Europe or in New Zealand or in Sweden? Yes, they are. We are seeing in these countries growth coming down, inflation coming down aggressively. So when you're looking at the restrictiveness of monetary policy breaking something like it did in 2007 with the US mortgage market, I would encourage people to look outside the United States, not in the United States.
Well, your thesis portends to that if something breaks, it will break beyond these shores. What is it in the credit markets in Europe that irks you so? And can it be anywhere near the scale of what we did see as the torch paper was lit in 2007 and a mortgage crisis here in the United States?
I would say the size of the potential credit crisis, if we want to talk about Europe, can't be the same size of 2007, simply because the amount of regulation that has been put through, especially for European banks, but all over the world, is quite impressive. So you start from a safer regulatory standpoint than you were in 2006 and 2007, but nevertheless, I want to invite the audience to reflect on the fact that most corporates in Europe do not obtain funding through capital markets, they obtain funding through the banking market, so through lending, direct lending from banks. And now these loans were generally, 5 to 7 to 8 years maturity, and they were mostly concentrated in the period when quantitative easing in Europe was running loose. So anywhere between 2015 and 2017, corporates in Europe, even triple-B corporates, could borrow for 7 to 10 years at very, very low interest rates. We're talking about 1.5% to 2% all-in borrowing costs. And today they're rolling over minus this funding at much, much higher interest rates. Some corporates are already under pressure.
So then this takes us to the thesis that we've been running with on Bloomberg through the week, that there will be a divergence between the scale and the pace of the Fed cuts relative to the ECB, relative to the UK. Translate that into spread trading for me. Is it bonds to bunds? Is it bonds to gilts? Where is the biggest outperformance in terms of those spread trades? I'm assuming that that's how you play it.
Yes, I think the best ways to place these are in the FX market and in rates markets. The rates markets I like to receive the most right now are Europe. New Zealand is a market that I really like to receive. I think the situation there is also precarious, and Australia. These are the 3 countries that I like to receive the most, where I want to pay the US against it. You can also play that in FX. The Aussie dollar or the New Zealand dollar do not look particularly well here.
And in terms of the commodity, I like the way you reflected on it as you bolstered your thesis, which is good to hear. You talk about deja vu in the commodity market. I look at gold. We're going to check these prices a little bit later on. Silver's the highest in a couple of years. Gold's making record highs. Oil is up for geopolitical reasons. But in terms of the additional plays, it is in commodities, isn't it?
Yes. I mean, if you're an investor, Manus, and you're looking at nominal growth north of 4%, so real GDP growth above 2 and core inflation around 2 or above 2. And then you're looking at the Federal Reserve coming in with 6 or 7 acts over the next 2 years, despite a strong nominal growth. What do you buy? Where you buy assets that do particularly well when nominal growth is strong and the Federal Reserve is easing and compounding this strength. Well, commodities, cyclical stocks. This is exactly the same that is happening in 2007 in the second half, and I'm not surprised it's happening again.
Let's just circle back. I like what Ian Lingen had to say over at BMO. He said, all the waiting and no seeing from Jay Powell. So we've had 2 moments of rhetoric. We're counting down to the jobs report tomorrow. These bond markets in the US have been jolted this week, and yet prices paid come in at a 4-year low on the services number. Does that reassure you that we could be incrementally getting closer to the start of the cutting cycle? And if so, what scale will that be?
Oh, yes, the Federal Reserve will start cutting in June, I think, simply because they want to get started when they have a new dot plot, when they have a new set of forecasts, and early enough to not be caught in the crosshair of political and election discussion. So June sounds pretty much about right for me. The fun thing is that June the Federal Reserve will start cutting in June, despite the economy probably still doing okay from a nominal growth perspective. And, for me as well, the Fed starting in June gives so much leeway to other central banks. The Swiss National Bank is already gone. That also gives cover to central banks like the Bank of England or the ECB to start cutting interest rates. And I think their cutting cycle will by far be larger and much, much faster than the US cutting cycle. And that is, I think, the trade in bonds, much more than focusing on the US, where the steepening is actually my preferred expression.
So the steepener is there. Do you think that real money came in this week? And you see these jolts above 434, 435. Some people are saying that's a ceiling, up to 450 on those ratchet higher in yields. Is that where real money comes in and buys? Do you believe that thesis, or is that just something being sold to me by the sell side?
Well, I would say as a former institutional money manager, I can tell you, Manus, that there are certain regulatory incentives at some point to come in. If you're a large pension fund, for example, okay, and you're looking at 30-year BBB corporate yields. So you can buy a corporate bond, 30-year maturity in the United States, and it's yielding 6.5%. That's roughly where we are today, okay, 6 to 6.5. You have your liabilities to immunize as a pension fund, right? And if you have a target return of 7% today, you can achieve that without taking any equity exposure. You can simply buy long-dated corporate bonds because 30-year rates are high and credit spreads are, let's say, decent. You can buy at 6.5% and you immunize your interest rate risk and you get your target return simply by buying long-dated corporate bonds. So yes, real money should be coming in at a certain level of yields in the long end.
Alfonso, thank you so much for being with us this morning. That is Alfonso Peccatiello, Macro Compass. You can pick up his tweets and get his research. It comes in my inbox every single morning. Other stories that are trending on your Bloomberg Timer this morning. This is what we've got. Benny Gantz is calling for an early election in Israel, ramping up the pressure on Benjamin Netanyahu. The War Cabinet member says polls should take place in September instead of as scheduled in 2026, and that would help prevent the rift in the nation. Swiss inflation unexpectedly eased, vindicating the SNB surprise rate cut last month and suggesting more might be coming. Consumer prices rose 1% from a year ago in March. That's the lowest reading in 2.5 years. Economists have predicted an acceleration of 1.3%. The Carlyle CEO, Harvey Schwartz, earned about $187 million in his first year at the firm. Schwartz has been tasked with steadying Carlyle for growth, boosting performance of key strategies, and bolstering its stock price, which had lagged behind the biggest publicly traded rivals. BYD plans to launch its first electrified pickup truck. That's for the global market later this year. The vehicle could challenge Toyota's Hilux and Ford's Ranger. Photos released by BYD show a boxy dual-cab truck being road-tested in an unspecified location. Now, while the company didn't release any details on the powertrain, performance, specifications and pricing, it's said to be a mid to full-size truck, and it will be the first new energy pickup. Coming up in the show, up on its car projects, Apple has eyes on what it believes are the next big thing. A robot, your next best friend. And Bob Iger's challenge remains, even as Disney, the CEO there, wins the proxy war. More on the challenges ahead for Bob Iger on Bloomberg. This is Bloomberg Brief. I'm Manus Cranny in New York. Well, after its car project failure. Apple is now moving towards robotics, which it believes has the most potential in the future, according to people familiar with the matter. Joining me now is Bloomberg's Kriti Gupta. Kriti, good to see you this morning. So the car didn't go so well. They spent a long time and a lot of money. Now I'm going to get a new buddy, a new friend from Apple, a robot.
I mean, maybe we might all. The point of this is kind of that there are pieces of that car, the failed project that they had, that can still be used in other ways. I think talent, Amanda, is the core of this story. You have kind of AI talent that was used and involved in the creation of the car. You have engineering talent that had looked into robotics and mass production of the car. All of those pieces, without the actual coming to fruition, can be reused for potentially robots. Now, this is interesting because we already know there was another player in the tech space that kind of tried to do this, Amazon, and their potential acquisition of iRobot, which has been squashed by the European Union in January. They dropped the deal, saying it wasn't worth the regulatory hassle. But it feels like the consensus here is that if it's not AI, if AI isn't this mass consumption product, this idea of home robots just might be.
I got to say, iRobot, the cleaning product sort of went sky high on the back of some of these stories. Talk to me about Alphabet, because this is a new diversion. This is an FT story. It talks about Alphabet wanting to charge users for search features powered by AI. So this is the infancy of monetization of AI at a democratized level, and that's what's interesting about this.
It is. It's a very marked difference in strategy from Alphabet. Remember, Alphabet gets most of its revenue from advertising here. They get it. It is free to the consumer. So to monetize a search engine risks, one, cannibalizing their own business, and two, losing some of their existing user base. And that's really why you saw pressure on those shares, that if this is really being taken seriously, could they lose the 1 billion active users they have around the world, not just in their Google search business, but even their YouTube business, for example, not to mention the variety of other products that Alphabet has under their umbrella. The AI piece is interesting, though, because similar to the Amazon story, where pieces of its former projects now help in its future, for Alphabet, there's a question of, is AI big enough for them to really use in their search engine? Is it better used in their cloud computing division? Remember, Alphabet, yes, a big tech company, is still third place when it comes to Microsoft and when it comes to Amazon Web Services.
Okay, Kriti, thank you very much. Kriti Gupta there covering the tech angle as we're waking up here in New York. It's just gone 5:19. Let me just show you what deja vu looks like. Okay. You've got gold slightly coming back from its sort of record high that we pumped through. Just had Alfonso Peccatiello again talking about flashbacks to 2007, rising commodity prices. You've got copper solidly through that 9,000 level. Gold, as I say to you, another record high taken out at 2,300, just coming back. Central banks have been buying gold for 9 months in a row. And silver just retraces from its July 2021 high. But copper is on the up. If you believe in the China rebirth story and growth story there, that is certainly helping the copper market this morning. Right here on Bloomberg. It is Bloomberg Brief. I'm Menace Cranny in New York. The heavy U.S. government debt, it adds to the list of market risks ahead. Bloomberg Economics' latest assessment shows that the debt-to-GDP ratio is on an unsustainable path. We caught up with Ray Dalio for his take on debt.
There are two constraints to debt. No, you can't get deeper and deeper and deeper in debt and spend without consequences, because when you borrow, you have to pay back. And then the question is, do you pay back in hard money or do you pay back in printed, cheaper money? So what you see are these two factors. First is the debt service squeezing expenditures, because as debt rises and interest rates rise, debt service as a percentage of your spending rises, and that squeezes out other types of spending. So that's a mechanical thing, and it works that way. And we can see it happening as we project over the next 5 and 10 years. It becomes more and more apparent. I won't get into all that. But the second is that as that becomes more apparent, then you have a situation where holders of the debt may not want to hold the debt, because one man's debts are another man's assets. And so if they are holding debt assets that either they feel cannot be well paid back or will be monetized, you don't want to hold that. So when debt rises as a percentage of income, and interest rates have to be high enough to satisfy the creditor without being too high to hurt the debtor, that balancing act becomes more and more difficult. And the key point is when the selling begins. Because when that selling begins, then it becomes a self-reinforcing problem because you lose money on that.
That was the Bridgewater Associates CIO, Ray Dalio, speaking to Bloomberg's David Weston on Wall Street Week. Coming up in this show, we're going to catch up with Marvin Barth, founder of Thematic Markets, as to whether the Fed will even cut rates this year. Right here on Bloomberg. Welcome back to Bloomberg Brief. I'm Menace Crenny in New York. Here's what you need to know. Powell signals the Fed has time to assess the data before deciding to cut rates.
On inflation, it is too soon to say whether the recent readings represent more than just a bump. We do not expect that it will be appropriate to lower our policy rate until we have greater confidence that inflation is moving sustainably down toward 2%.
Apple explores personal robotics for its next big bet after Project Car fizzles. And the Disney CEO Bob Iger won the proxy war, but now battles unresolved challenges from the struggling movie business to finding his successor. A very good morning. We've had the soothsayer, that is Powell, assure the markets that rate cuts will come and that the recent bumps in the road on inflation are just that. They are bumps in the road. So that angst has been taken out. In terms of flow momentum, some people question, was momentum running out of breath? Will Citi say persistent risk demand in terms of momentum flows? Keep an eye on Meta. We've got Wells Fargo upgrading the stock, 20% upside. Strong first quarter in terms of the numbers. The stock is one of the biggest pre-market risers this morning, up over 1.33%. I want to show you what's happening in the bond market. This is the first 30 minutes of this show. Alfonso Peccatiello likes steepeners. This is the 10-year yield over the past 4 days, 22 basis points at one juncture. We've given some back because of those soothing words and the prices paid. Soothing words from the Fed, from Jay Powell, that rate cuts are coming, and indeed from prices paid being the lowest in 4 years. And so to a certain extent, that takes some of the heat out of this bond market angst that we had seen over the past number of days. I love what BMO Ian Lingham had to say. All the waiting and no seeing. So we need to see some delivery. And again, Alfonso Peccatiello suggests that the Fed is living in a 2007 redux. Another Fed governor spoke yesterday, and it was Adriana Kugler. This is what she had to say about borrowing costs.
Even with demand growth cooling, given the backdrop of solid supply, my baseline expectation is that further disinflation can be accomplished without a significant rise in unemployment.
Joining me now is Marvin Barth. Good to see you, Marvin, founder of Thematic Markets. It's been a while, sir. So here we are with Powell, Kugler, assuring us that, well, Powell assuring us the rate cuts are coming and we should not be distracted by bumps in the road. And then we have a 1-2 punch that inflation can be tamed without something systemically going wrong in the employment market. Where do you stand on the taming of inflation, bringing inflation back to heel without a major disruption? Good morning, Marvin.
Good morning, Menace. It's nice to be with you again. Look, I actually stand in both camps, if that sounds strange. I don't think that Chair Powell is correct. I don't think they're going to be cutting, certainly not 3 times this year. If they do cut, it's maybe a maximum of 1 time. Just the economy and inflation are not going to cooperate on that front. The final mile for inflation is going to be difficult. but the economy is booming. It is doing fantastically well. So the hard landing scenario isn't there either. So actually, Governor Kugler is actually correct. But, you should not pay attention to the Fed's forecast. They've been wrong this entire cycle. Why should you start paying attention to them now? They've been 100% wrong the entire time.
They've been 100% wrong. Therefore, the dots. So I'm going to go with your thesis, Marvin. These are not my subjective opinions. I'm extrapolating your thesis. So they've been 100% wrong all of the time. The dots are completely wrong. The guidance is completely wrong. I mean, are you throwing everything out, Marvin? Because that, I'd have to challenge that a little bit. Come on.
No. Oh, okay. Well, tell me the last time they were right. I mean, they haven't.
To be fair, they got transitory wrong. To be fair, they've been promising that we're going to make the last mile down. Okay, let's contain ourselves. So if they're wrong and they're not cutting, I want to take that into markets. This mini backup that you had in yields this week, does that go much further and extend much higher if there are no rate cuts coming and inflation is, as you say, going to be sticky and the Fed is wrong?
Well, look, I think the underlying problem here is that people have the wrong model for what R-star is. They're still trying to use the Laubach-Williams model and listen to the Fed. The Fed is very dependent on that model. That model has been consistently wrong, and that's why they keep getting it wrong. And markets are using the same model. Most of the economists that you're going to have come on here from any of the big banks are going to use the Laubach-Williams model as their measure of the neutral interest rate. Now, if actually neutral interest rates are sustainably higher, which the fact that the economy is booming amid high real interest rates right now is telling you that indeed the neutral rate is higher. I mean, it's obviously the fact there. And so what's happening is, you're right, exactly as the Fed keeps trying to forecast, oh, we're going to be able to cut. Markets have also, if you look at one-year forward rates, they have been consistently wrong for the past 3 years. They have not come down the way that the markets expected, and I think that's still the case now. It still makes sense to be a payer of one-year rates, to be short 2-year bonds.
What does it mean for this equity market then? Because I've had everybody come on the show and go, you don't need to worry about rate cuts. That's not going to push equities higher. And if I take your thesis, we're booming. Unemployment is low. Everybody has jobs. We're getting wage cuts. So no rate cuts is not a distraction to the momentum and trajectory of U.S. equity markets.
Yeah, well, let's think about what actually is behind neutral rates. And this actually gets to the fundamental problem with the Laubach-Williams model. The Laubach-Williams model seems to derive, not seems to, it actually does derive the neutral rate from the rate of inflation. That's not where neutral rates come from. Neutral rates come from the marginal product of capital. If we're having a productivity boom that is starting to show up now in the data, that's driving this big capex boom that has actually been going on for 10 years now, then what should happen is earnings go up and real interest rates go up. And that's exactly what we've seen. So equities actually are going to do perfectly fine through this.
So are we in, you talk about a productivity shift, are we in the birth of that, Marvin? If we spent 3 months now obsessing about AI, it's coming more alive every day. We talk about it in a different way. So how much productivity improvement do you think that we're going to see? Is it going to continue? And are we at some kind of paradigm shift in productivity, to coin a phrase from another great central banker?
Well, I go back to my American roots, even though I'm here in London. I'm gonna use a baseball analogy, not a cricket analogy. We're in the middle innings, right? So to me, this feels very much like when I was at the Fed back in the 1990s, when people were still debating, are we actually having a productivity miracle? Because it hadn't shown up in the data yet. Now, of course, we saw that it was there, but it took a while for it to show up in the data. That's exactly where we are now. And it's not about AI. The thing that's been driving this has been automation all along. What people have thought was deglobalization that was politically driven was never politically driven. That may have added to it. COVID added to it, of course. What's been driving it is it's actually cheaper to use robots and automation in the U.S. than it is to use an outsourced globalized supply chain. And that's been going on for 10 years. You can see it in the data.
Does that accelerate if we get a change in political complexion in the United States of America. Of course, what I'm referring there to is if there's a shift from Biden to Trump and to a GOP sweep. Does that thesis that you put forward, does that accelerate over the next 4 years if that is the outcome, Marvin?
I think the bigger accelerant was twofold. It was one, COVID teaching businesses that indeed the costs of disruption from an outsourced globalized supply chain were incredibly high and that they could do it just as cheaply with robots now. So that was a big one. But also, I know that a lot of Biden fans are really going to be upset about this, and I don't remember who coined the term, but Biden's policies are basically polite Trumpism. So I'm not sure there's a big difference there.
Marvin, what a way to sort of circle off and leave the conversation there. You managed to get baseball in and a bit of politics. Listen, it's great to have you back on the show. Do come and join us. And when you're in New York, feel free to get up early and join Danny and myself. That is Marvin Barth, Thematic Markets, my guest this morning. Investors are divided, as Marvin has been saying, on whether the Fed will cut or how many cuts we will get this year. So let's just take a listen to the CIO of T. Rowe Price and what he had to say.
One of the things that really stands out to me is if you go back to what Powell said very early on, he was a student of what happened in the 70s. And if you go back and you look at the mistake made then, it was cutting too early. And if you map the CPI to the very beginning of this cycle versus the last, it's following a similar curve. And if they go ahead and they start cutting now, I think they're in danger of making the same mistakes.
Do you perceive that as the biggest risk then, cutting too soon and not holding too long?
I do.
What would that mean for bond markets if they did?
Well, I think you would see what would happen is the spike up, and then you would have to react to that in a way that would put them on their back foot. And that would lose credibility, and you would have a big issue for them.
I want to challenge one thing that you said, which is that Powell is a student of the 70s. Is he really? Because right now he sounds pretty much like the most dovish member on the FOMC and sounds like he really wants to cut rates. And frankly, a lot of people are looking at that as the reason to buy stocks. Are you saying that they have it wrong?
No, I'm not saying that they have it wrong. I do think he is a student of history, and what he has to do is keep that group, find the middle ground between that group and present it in a way that presents consensus broadly within that committee and balance out the other speakers. So I think he's very much trying to do that right now. But again, I think as you look at the next several months, the idea of cutting when we are where we are from an economic perspective just doesn't, I think, make a ton of sense right now.
Which raises this question, if you do think that this inflation is stickier, and you think that the risk of a 70s type of scenario is greater than the risk of some sort of unforeseen downturn, do you just buy commodities, buy stocks, avoid bonds at all costs? Because right now it's not clear that this FOMC has the conviction to really make the right call and not have a policy error.
Well, I wouldn't go that extreme, right? So as we've unfortunately or fortunately said, we're right now on our asset allocation committee, we're actually dramatically neutral is the phrase that we've been using between stocks and bonds, which is not the most exciting fodder for the media, but that's where we are. I do think commodities, though, is really interesting. And so we are, within our equity portfolios, we're overweight energy in the vast majority of those and in different ways. And we think there are some really interesting opportunities there coming from our bottoms-up work.
The divergent views on what we should do, what we should expect from the Fed. That was the CIO at T. Rowe Price speaking to the surveillance team. Quick snapshot of what's going on in the rates market. This is the yield curve. We've had Alfonso Peccatiello favoring steepeners. You can see we've had this re-steepening of the curve as the debate rages on whether you will and should have rate cuts this year in 2024. Coming up, film and TV giant Paramount is in exclusive talks with Skydance. The details on the players coming up on Bloomberg. This is Bloomberg Brief. I'm Menace Crenny in New York. Shari Redstone has reached a tentative deal to sell her controlling stake in Paramount to Skydance. The media drama has been developing for months. Kimberly Adams joins me now to talk it through. So we were just chatting in the break there. You said this is a tentative deal. So what is it that she's got an optionality on? Everybody seems to have an interest in Paramount. What's she locked in?
So right now, what this move means is that it's just going to put a pause on conversations with these two companies right now, and it's not going to allow any of the other suitors to get in while they talk. So you've got suitors like media mogul Byron Allen. You've got Warner Brothers also interested. And, of course, the big one, Apollo Global Management, really had a stake here. They really were interested. This is going to give Skydance the edge over Apollo. Earlier, they offered to pay about $11 billion for Paramount's movie studio. So I don't think that set well with Paramount. So then they came back just on Sunday and they offered to buy the entire company. So on the DL, it looks like, you know, Paramount was already talking to Skydance, so they already had plans to do this. So by the time Apollo came back and said, wait a minute, we'll do the whole thing, the whole company, they said, well, not now. We've got 30 days. We're going to have this talk with Skydance.
The train had already left the station.
The train had already left the station.
Okay, and so we'll see what optionality they get. If I said to you, look, what are the hurdles? I mean, they've had a lot of interest.
Yeah.
Okay, so we can sit here and debate whether TV's still got a future or not. Hopefully it has. But what are the hurdles to getting this deal done?
Well, right now you have the two have already come to terms with this deal. It's not official, but it is tentative. So they've come to terms with this. But Skydance has made it clear that in order to close the deal, that it needs to make sure that it's allowed to merge with the studios. The studios are vital. That's what people want. They want the studios as well. So Skydance has partnered with Paramount, we know, in the past, with movies like Top Gun Maverick. So I feel like, you know, they feel the need for speed. They want this deal to happen right now.
They want it to happen. Best movie ever.
Yes.
There you go. We managed to get it in.
Yeah, it's a great movie.
Let's take a look at that. That takes you back. We were all a bit younger when we watched that. Kimberly, thank you.
You're welcome.
Thank you very much, Kimberly Adams, on the deal flow this morning. Now, we've been covering this story for quite a while. Of course, it's about Disney, the CEO there, Bob Iger, winning the proxy vote over the investor Nelson Peltz. The headaches remain. Reviving the movie business, selecting the firm's next chief executive, Iger's real challenge for the entertainment giant. It begins now. Charlie Wells is with me. Charlie, good to see you. He has some swagger in Iger to win the vote, hasn't he?
Yeah, I mean, look, Iger is known to be the most powerful executive in Hollywood, and this really was a big thorn in his side that sort of gives him some steam going into the turnaround that he really needs to execute at Disney. And man, as you said, you know, this difficult proxy campaign is now over. It was one of the biggest, most expensive. Disney spent $40 million on the campaign. They sent campaign videos to individual investors. There's a lot of retail investors in Disney. They used Donald Duck's uncle in some of these videos. They talked to institutional investors to win it. But as you said, the challenges are here. And a lot of the issues that Nelson Peltz was talking about succession, about some of the content, those are not solved and they still remain.
Now, is Nelson Peltz going to retreat? I mean, he says he's going to continue to watch the performance from afar. So it sounds as if it's sort of slightly less aggressive tactic in the first response. What do you think is the next step for Peltz?
Yeah, I mean, look, this is his second proxy battle with Disney. You know, the last one was just, you know, the year before. And so what we do know is that Nelson Peltz's Tryon Partners controls $3.5 billion of Disney's shares. So they still have a lot of skin in the game. And as, you know, I mentioned, those issues just are not resolved yet, you know, and some of these content issues are difficult. It's really difficult to produce a movie. It's really difficult to produce a hit. And that was one of the issues that they were talking about. And of course, Disney has long had succession issues. Of course, we know that Bob Chapek was really only in the seat for 2 years. Bob Iger is back in his kind of second tour of duty as the CEO. And again, that wasn't solved yesterday, and it really remains to be dealt with.
Look, Iger has taken the streaming business, dragged it kicking and screaming. He's cut a lot of jobs. He's gone for a big capex plan in the parks. You know, where does Disney go from here?
Yeah, I mean, look, it's looking like the fundamentals are pretty strong. You know, in February, in one of their earnings calls, they actually took the rare step of bringing out some profit projections for this year, and profit is expected to be up 20% this year, so that's a positive story that they've got. We know that, you know, they treated the proxy battle like a campaign, and in a lot of ways, they're treating some of their infrastructure investments sort of like the Inflation Reduction Act. They are saying that they're going to put $60 billion into parks, and we know that parks are really important for Disney. They're, 70% of profit for this company. And so trying to make sure that they're making these investments, that they are, evolving for the streaming era. We heard Iger talk about a deal that he's got with some competitors to try to modernize ESPN for the streaming era. These are the things that they're going to need to focus on, but these are the things that are really difficult.
Indeed. Now, I've always got an eye on what's going on in the music industry. Tell me about Kiss. They're selling their catalog to Popeyes for $350 million.
Yeah, look, I mean, it's really interesting, and it kind of speaks to the issue of content and trying to modernize content for the modern era, just like, Disney is struggling with. And Kiss here, for $300 million, they're selling it to a Swedish entertainment group, actually co-founded by one of the members of ABBA. They are the company that's behind the ABBA Voyage here in the UK, and that makes $1 million a week in the UK. So I think Kiss is really trying to think about, what their legacy will be. They sold not just the catalog, but also, imaging rights. And what our reporting has said is they've already gone to the studio to put those body suits on that they need to create avatars for these shows. And I think the takeaway here is that content is still valuable. Consumers are still willing to pay for it, but it's about where does the consumer want to enjoy that entertainment? Do they want to do it through terrestrial television, or in the case of this ABBA experience and a potential kind of Kiss experience, do they want to go to some kind of theater and have that 3D kind of avatar experience? And it's sounding like increasingly the answer is yes.
Indeed. Well, of course, we've seen a whole genre of avatars, certainly around the ABBA phenomena. Don't know about the hair and the makeup, though, Charlie. Don't necessarily know that the leotard and the hair and the makeup is necessarily for me. Charlie, thank you very much. Charlie Wells on the Kiss catalogue on the auction block. Coming up, we're going to take a look at some of the market-moving events that'll set the agenda for you right here on Bloomberg Brief. This is Bloomberg Brief. I'm Menace Crenny in New York. A look at what is ahead for you today. More Fed speak, this time from Thomas Barkin, Patrick Harker, Neil Kashkari, and more. We also get a round of jobless claims data and trade data coming through at 8:30 a.m. Eastern. And the Bloomberg editor-in-chief, John Micklethwaite, sits down with Argentina's president. That is at 3 p.m. Eastern. Don't miss that conversation. In terms of other stocks that you should probably keep a roving eye across, it's on Tesla, up 0.75%. Musk says that he's boosting Tesla Pay to stop OpenAI from poaching staff, so a little bit of a bid there. Micron up 0.1%. You've got analysts there seeing limited risk from the quake, so that is sort of got a nice bid to it. And Amazon up 0.5%. We have news flow coming through that they are cutting jobs at their cloud computing division. Of course, the revenue at the cloud computing division was under a lot of pressure. That's state of play on those individual equities. Keep an eye on those. In terms of the rest of the assets, we've got equities bid up, we've got yields rolling over, so a little bit of a complexion for you. Yields coming up. We had been on 22 basis points up until yesterday when Powell spoke, and of course the prices paid coming in lower at a 4-year low. That helped the yields roll over. The dollar's down by 1/8 of 1%. SPOOs are up 1/3 of 1%. Marvin Barth just with us there and I saying the equity market in the US remains unchallenged. Go momentum. That's it for Bloomberg Brief. The surveillance team are up next.